We have Ethan Harris, B of A Securities global economist, and Emily Roland is co-chief investment strategist at John Hancock Investment Management. Emily, Ethan, thank you very much for joining us both. Ethan, maybe we'll start with you. First of all, we kind of understood the backdrop with which that 0.75% rate hike went into effect for June. Is there anything here that suggests that the Fed is still trying to play catch up right now, or do you feel like they have a good handle on just the kind of macro picture that we are all dealing with right now?
Well, I think this was a watershed meeting. This is where the Fed does the big capitulation. They say, you know what, we're behind the curve. We can't play around with 25 basis point cut hikes. We can't do a hike, see how it goes, then do another hike. We have to move in chunky 50 or 75 basis point moves. I think it was the right thing for the Fed to do. I felt for the last year they were kind of slipping behind the curve. But I think this puts them on track. It's kind of a sensible approach to a very serious inflation problem. You can't cure inflation without risking a recession.
So that recession, that possibility is coming much more into the discussion, Emily, certainly over the last maybe 2 to 3 months worth of time. In large part because of things arguably outside of the Fed's control, wars in Ukraine and Russia and everything else. But do you feel as though the markets have been adequately prepared for this? I mean, this idea of a rate hike has been going full steam for quite some time, months now. It's the 0.75% and perhaps in subsequent times that same level of rate hike as well that had markets a little bit scared. Are they as scared now, in your opinion, than they were, say, 3 or 6 months ago?
Well, it depends on the market that you're talking about. So as the likelihood of a technical recession increases here, of course, we had negative 1.5% GDP growth in the first quarter, and the Atlanta Fed has the second quarter tracking at negative 2%. But we've got to think about where is it priced in. So the equity market, of course, has fallen into bear market territory, looking at the S&P 500. The typical bear market sees a decline of 34%. So frankly, we could be 2/3 of the way there in terms of equity prices. But when you look at the bond market, it simply is not pricing in a global economic slowdown or a recession. Typically what happens in an economic slowdown is that bond yields actually come down. And what we've seen over the course of this year, of course, has been this relentless backup in bond yields across the curve. So we're looking opportunistically right now at Treasury yields close to 3%, the aggregate bond index yielding 3.7%. You haven't been able to say that since about 2010. And we think this is an attractive opportunity to add to quality within fixed income positions and, frankly, to pick up quality on the equity side in areas that have been thrown out with the bathwater.